I can't believe he just said this. I'm your host, Steve Van Metre, and thanks for joining me today. The former Treasury chief says they haven't gone far enough. But is he wrong? Let's go to Bloomberg, where he picked today's story up. As Larry Summers, former Treasury chief, says the Fed will need to boost rates more than the markets expect. And as you can guess, I think he's wrong. The former Treasury chief warns of a high interest rate recession and says the economy could slide suddenly like an avalanche. We have a long ways to go to get inflation down to the Fed's target, Summers told Bloomberg. As Fed policymakers, I suspect they're going to need more increases in interest rates than the market is now judging or than they're saying. And I completely disagree with this assessment. And not only do I disagree with it, later in the show, I'm actually going to give you the hard evidence to prove that Summers is completely wrong, because I have no idea what he's looking at. But let's go a little bit further and see what his point is and find out why he is so wrong. Interest rate futures suggest traders expect the Fed to raise rates to about 5% by May of 2023, compared with the current range of 3 3/4 on the low end to 4%. And just to put this in perspective of what the market is expecting, they now believe that in December there will be a 50 basis point hike, which was largely confirmed by Fed Chair Powell just past week. And then that would mean there will be 2 more 0.25% hikes. The Fed will gradually taper off, and that by May, they will actually be at full pause, although it's looking very realistic that the Fed will be pausing well before May. But so far, I want you to understand what the market is pricing in. Economists expect a 50 basis point increase at December 13-14 meeting, as well as the Fed funds futures, with the Fed officials are scheduled to release their next projections for the key rate. 6 is currently a scenario we can write, Summers said, with regard to the peak percentage rate for the Fed's benchmark. And that tells me that 5 is not a good best guess. So I just want to be clear here of what he's saying. The market, which is who the Fed actually follows, for the moment says 5 is it. By May, you've capped out, you're done. Although I think they're pretty much done by already, and I can create the proof, show you the proof of why I think the Fed should be done. But even though we know they're going to hike in December, what Summers is saying, look, by May, they're still going to need at least 4 more 0.25% hikes, or maybe they need to do several 50 basis point hikes before they taper down to 25 and then pause. And he couldn't be more wrong. Summers was speaking hours after the latest U.S. monthly jobs report showed an unexpected jump in average hourly earnings. He said those figures showcase the continuing strong price pressures in the economy, and well, we'll prove that wrong as well. For my money, the single best measure of core underlying inflation is to look at wages. My sense, said the Harvard University professor, is that inflation is going to be a little more sustained than what people are looking for. And of course, we've made the case for this already, that inflation here in the U.S. is largely a construct of 2 forces. One, gasoline prices, which on a year-over-year rate of change are suggesting that the CPI should be closer to 2.5%, and import prices, which are rapidly moving down. Now, yes, there are other factors that get mixed into it, of course, but those are the 2 key ones that matter. And of course, we also know that owner's equivalent rent, which is the Bureau of Labor Statistics' best guess of what rents are, because they have no actual way to calculate them, usually hits the CPI with a lag, and we'll probably see that for a little bit longer before that fades off very quickly. But now let's tackle Summers' view of wages and see what's really going on. Because in this chart, we've got the average hourly earnings of production and non-supervisory employees in blue against the consumer price index in red, both on a year-over-year rate of change. And what we can note, and what we already know, this isn't a surprise, is that wages aren't keeping up with inflation here. So why this is even a concern to Summers is baffling me, because what I understand is consumers can't afford goods now. They cannot afford the goods and services they were used to, and that will lead to less consumption. So why he thinks this is a problem, well, I'm not sure, but let's go a little further to see his explanation. Because another thing that Summers is missing is that average weekly hours are falling off. Here we are looking at production and non-supervisory. So even if wages are going up, notice that the amount of work they're getting, the hours at those higher wages, is rapidly dropping off. We're not near levels where we typically see a cliff, although we can look back and say when we're at this level or even a bit below, we tend to be recessionary. But here's what he has to say. Average hourly earnings rose 0.6% in November in a broad-based gain that was the biggest since January, and were up 5.1% from a year earlier. Wages for production and non-supervisory workers climbed 0.7% from the prior month, the most in almost a year. And I want you to hear so far of what, these political elites, and of course being the former Treasury Secretary, the former political elite, what they're trying to say is, hey, wait a minute. Not only do you have a job, which is a problem, you're making too much money. We'd like to see less of you working, and we'd like to see wages cool off. Now, that doesn't make a lot of sense. But what our chief strategist, Jeff Snyder, had to weigh in on these numbers is, he said, Steve, what everybody is missing, including these so-called experts, is there's a very simple formula that the Bureau of Labor Statistics uses, and on the bottom of that is hours worked. So he said if hours worked is dropping faster than expected, then it pushes wages up. He says the problem is they can't understand their own data. While a number of U.S. indicators have suggested limited impact so far from the Fed's tightening campaign, Summers cautioned that change tends to occur suddenly. He said there are all these mechanisms that can kick in, and at a certain point, consumers run out of their savings, and then you have a Wile E. Coyote kind of moment, he said, in reference to the character falling off a cliff. Now, I want you to get what he's saying so far is, hey, I think rates need to go higher. I think the market's wrong. I think the Fed's wrong. And oh, by the way, I think too many of you are working. I think your wages are going up too fast. And if that isn't bad enough, then at some point, the market's just going to fall off a cliff. The economy is just going to have a moment where it realizes that things are really bad. And when you put all of what he's saying into context, the question that I would ask is, how can he see that the Fed and the market is wrong? If he truly believed the economy was on the precipice of a cliff, then wouldn't he suggest that perhaps the Fed back off a little bit and wait and see? Well, he cites savings rates. He's got a good point there. Because the personal savings rate is near its all-time low. It's just fact above its all-time low, as we covered in a prior show, suggesting that consumers, they have no savings left or very little because they're not able to save much out of their current checks. In the housing market, he says, there tends to be a sudden rush of sellers putting their properties on the market when prices start to drop. And at a certain point, you see credit drying up, forcing repayment problems. And again, it doesn't make any sense, because even if credit dries up, what does that have to do with someone making a payment on their existing loan? And since when do prices, because real estate prices fall, do people rush to sell? And we can go back at the last crisis, which was a real estate crisis, and we can note that the reason people sold is they lost their job and they had too many homes. They had speculated on a number of homes. They needed to liquidate some of the ones they weren't living in to pay for the ones they had. And so what you had is people selling. There weren't people out there saying, well, my house went down by a few $1,000s or maybe even tens of $1,000s, so I'm going to sell. Because what do they end up needing to do after? Buy another home. You don't see this trend in the United States where people say, well, I'm going to sell my home and go rent for a while. It seems to be that once you have a home, people like living in a home. So the notion that he says that prices are going to fall, there's going to be a rush of sellers, I think he's missing the bigger picture of what causes people to sell their home. Once you get into a negative situation, he says there's an avalanche aspect, and I think we have a real risk that's going to happen at some point for the U.S. economy. I don't know when it's going to come, he said. But when it kicks in, I suspect it'll be fairly forceful, which of course begs the question is, how could he be saying the Fed needs to keep hiking when he's concerned that we're perhaps going to fall off a cliff? The former Treasury chief also warned this is going to be a relatively high interest rate recession, not like the low interest rate recessions we've seen in the past. And that's a statement I actually am not sure how to comment on, because it doesn't make any sense to me at all. Summers reiterated he didn't think the Fed ought to change its inflation target to, say, 3% from the current 2%, in part because potential credibility issues after having allowed inflation to surge so high the past 2 years. And of course, we also seem to wonder is why he doesn't think the Fed has credibility issues now, considering I think they've got a whole lot of them and have had them for a long time. but perhaps he doesn't see it that way, but most former insiders don't. But now let's look at the obvious issue of why Summers is wrong, why the Fed is not going to 5% or even 6% or whatever ridiculous number people want to make up, is because the bond market is already telling us that the Fed should be at peak federal funds rate. And the fact that the Fed continues to hike tells us that perhaps the one thing that Summers is right about is that cliff may be a lot closer than we think. And we can go over to the U.S. Department of Treasury, which every day, about 15 minutes after market closes, publishes the Treasury par yield curve rates. And here we can note that the 1 month as of Friday's close was at 3.91%. And we can look to 5, 7, 10, 20, and 30 year and see that they're all below the 1 month rate. And 3 years are at 3.99, suggesting that they're not far and were just recently slightly below the 1 month. And when we put that all in perspective, what we can see here is the federal funds rate in blue against the 10-year minus 3-month Treasury maturity yield curve. And what we can note is that every time when 10-year yields are below 3-month yields, we are at peak federal funds rate. And why Summers doesn't realize this and understand it, I don't know, but it's also telling us that a recession is coming soon. It doesn't mean tomorrow, doesn't mean next month. It's a matter of months away potentially now. But what Summers is, again, I said what he's right about is I think the cliff is coming, but I think his setup for it is a bit wrong. And something we were right about, and we talked about in a prior show that happened, well, is this. Threat of a rail strike reveals persistent supply chain risks to the U.S. economy. And I said there's no way that Congress or President Biden would allow a strike to happen. And sure enough, President Biden signed a bill into law on Friday, compelling freight railroads and their workers union to accept a labor agreement, averting a strike that might have disrupted a logistical linchpin of the economy. Even with the dispute resolved, the episode brought about a heightened awareness that supply hiccups could become an ongoing feature of business life in America. And with that, my question to you is, do you think Summers is right? Do you think the Fed needs to go well beyond the market's expectation? Or do you think he's completely wrong? And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.